Good afternoon, ladies and gentlemen, and welcome to the Revolution Bars Group PLC annual results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from Revolution Bars Group PLC. Rob, Danielle, good afternoon.
Good afternoon. Thanks, Jack. Welcome everybody to our annual results presentation for 2023. You've got myself, Rob Pitcher, the CEO, and Danielle, our CFO. I've been with the company about 5 years now, and Danielle joined in the middle of COVID, so about 3 years in so far. So what you'll have from us today is a bit of an introduction, and then you'll have me taking you through some headlines, but then I'll hand over to Danielle to do the financial review, and then back across to me for a bit of a deep dive into the sort of brand strategies for the group, and a summary. And then as Jake's alluded to, we will then take the pre-submitted questions, but also any live questions that come through. So with that, I will get on with the presentation. So this first slide just talks through the structure of the group for those of you who may be new to the group or less familiar. So we've got the two long-established brands, so Revolution with 46 sites in it, and then Revolution de Cuba, which was created in 2011 with 17 sites for Revolution de Cuba. Revolution being very much 18 to 30-year-olds focus, with lots of DJ-led entertainment and a focus on vodka and cocktails. And Revolution de Cuba for a slightly older age group, sort of 30 to 45-year-olds, focused on rum and sort of Latin and Cuban culture, and therefore lots of live music and entertainment as far as that goes. We have then created two new concepts during the sort of COVID period, of which we have two playhouses and one Founders & Co. And Playhouse is our take on competitive socializing. So if you imagine all the games you would find at the end of a pier put into a bar environment, air hockey, basketball hoops, all sorts of competitive socializing, go for golf, etc. That's all in there. We've got two of those. And then Founders & Co. is our take on a market hall concept, and that has got 4 independent food traders, a coffee shop, a vintage clothing shop, a barber's shop, and an event space. And then we run the bar and charge those retailers rent for using our space. So that is the one, Founders & Co. And then we did the acquisition of Peach last year, which was 21 at the time, now 22. And again, I'll come on to talk about that in a little while. But that is largely in the south of the country, very lovely gastropubs, which provides good balance to the group portfolio. So I hope that gives you an introduction and a flavour for the estate. And now I will take you on to talk about the headlines for the previous 12 months. And I guess starting with, look, we were pretty delighted to deliver the forecasted adjusted EBITDA for the group, which was 6.6 million. As I say, Dan's going to talk you through the numbers, but that was a number put into the market last January. And given the market has remained pretty tough for hospitality, we were pleased to have landed on that 6.6 number for the full year. The Peach acquisition has gone very well, and as I said, includes our first new opening. Sales have continued to flourish in that part of the business, and we are on track delivering those synergies as well. And again, I will talk to that in the presentation. The bars business, however, has been particularly impacted by the cost of living crisis, most specifically the Revolution brand, and that is largely down to a 18 to 30-year-old focus, and specifically the 18 to 25-year-olds really suffering from a cost of living crisis point of view, and the pressure on their amount of disposable income. Bars has been particularly tough, but pubs, as I say, since acquisition has performed very well. However, in the bars market, Revolution de Cuba has outperformed. We get the segment tracker for the whole industry, and Revolution de Cuba has been above the bars market for the whole of the last 12 months, or since the change in calendar year. Has performed pretty well and actually is now back up into growth, which we're very pleased about. In more recent weeks, Revolution has benefited from a strong student return and indeed a decent Halloween this week as well, we're pleased to report. Founders & Co. Continues to trade strongly. I guess what we've also done is taken quite positive action across the brands from a cost control point of view, really focusing in on labour control. We've delivered a saving of £400,000 based on the implementation of a new labour management system. And during this time, guest metrics have stayed at record levels across the three core brands. The propensity to recommend after guest visits never been higher. So we're pretty pleased with the fact that the brands are resonating with guests. It's just that some of the guests are struggling to afford to come out. And then I get from a sort of pleasing point of view, again, on the cost front, the relentless increase in cost does appear to be abating somewhat. Utilities seems to have peaked. Consumer confidence, albeit has taken a bit of a hit in the last couple of months, has come up off the bottom of where it was sort of this time last year. But I guess the one thing that does hang over us is industrial action on the railways. Is something that is out of our hands and can potentially have a big impact on our business, as it has done over the last sort of 12 months or so. But what we are pleased to say is that festive bookings are running very, very strongly. And as reported last week, we're 17.7% ahead of this point last year. So, Christmas is a critical trading period for us, and being sort of 17% up on booking numbers is very pleasing for us at this stage. So they're the headlines, and then I'll hand you over to Dan to take you through some of the financial details.
Thanks, Rob. Hello, everybody. Looking at the income statement firstly, we're talking today about the FY23 results, which are the results for the year ended the 1st of July 2023. We bought Peach Pubs in October 22, so their results are included in the income statement for the 8 months period from that time. Over on the right-hand side, you can see the IAS 17 P&L. That's the old accounting standard, which treats rent as an expense to the business. All of our pubs and bars are leased, so rental is a significant expense to the business. Hence, it's this presentation of numbers over on the right-hand side that the board focus on to assess the profitability of the business and to track comparisons year on year. For transparency, we've included FY23, the year we're reporting on, then last year, FY22, and then FY19 being the most recent non-COVID affected year. On the left-hand side of the table, you can see the statutory income statement measures which treat leases as owned assets, and hence you don't see a rental expense in the P&L. Again, 3 years worth of IFRS 16 results on the left-hand side. So, orientation complete, I'll talk you through the highlights in the P&L. I'm really pleased, as Rob's just mentioned, that we hit the IAS 17 EBITDA expectation that was set in January of 6.6 million. You can see this on the first column on the right-hand side. This compares to 10.2 million in the previous year when, while we did have a COVID-affected Christmas, we did have lots of post-lockdown pent-up demand, and the cost of living crisis hadn't yet hit. Under IFRS 16, over on the left-hand side, the business made EBITDA of 17 million. The main difference between this and the IAS 17 numbers, as I said, were the rental charge. Revenue is up by £12 million to 152.6 million, an increase of 8% year on year. As I said earlier, this includes the acquisition of Peach Pubs this time last year, which contributed 22.6 million over 8 months of the FY23 year. Like group sales in FY23 were minus 8.7% versus last year, with the switch to working from home, train strikes and the cost of living really hitting our revs guests in particular. And compared to pre-COVID, similarly challenged like-for-likes. We were pleased to see in FY23 a strong Christmas trade with excellent pre-booked revenues ahead of pre-COVID, showing that guests really love our parties, but it was the train disruption, either through strikes, cancellation, or just lack of confidence that really put a dampener on trade. Gross margin at 76.7% is 1.5% lower than in the previous year, with the reasons for this being split between the lower late night trade, there's no happy hour or discounting in that late night time slot, and also the acquisition of Peach, where food participation is higher and the margin on food is lower than that on wet. That said, it is good to see margins higher than pre-COVID, and this is true of both Revs and RDC, with our commercial teams sharpening the pencil significantly as we negotiate with our suppliers. Following the visible impact of the train strikes in half one, particularly on Christmas, cost control was the order of the day in half two, and we reduced marketing and training spend, as well as lower usage of consumables in sites in particular to battle against the inflation which was pervasive across all areas of the business. We were pleased to see energy prices dropping, and hopefully we won't see further spikes with the current global turbulence. Further down the P&L, we adjusted a loss before tax of 2.1 million under IFRS 16. However, I do need to flag that on an unadjusted basis, the loss before tax was 22 million, which is what you will see on the face of the income statement in the prelims. The difference between the adjusted number and the unadjusted measure are exceptional items, which in the main relate to non-cash impairments of right-of-use assets, which were required due to the softer trading achieved and the cautious look-forward assumptions that the business is taking. There's also a cash exceptional of 1.5 million due to the acquisition of Peach Pubs. Peach's like-for-likes since acquisition have been 14.1% compared to pre-COVID, a healthy and very welcome contribution to the group numbers. If you'd like to see the detail on the exceptionals, they're in the appendix of the presentation. Looking now at cash. This isn't a statutory cash flow, as ignoring the payment of rent until it becomes an imputed financing cost isn't, in our opinion, the best way of understanding cash flows of a multi-site leased business. As a result, on the far left-hand column, you can see the opening net cash position at the start of FY23 of 4.1 million. Then the rent charge of IAS 17 EBITDA of 6.6 million, and then the cash flows associated with CapEx and the acquisition of Peach and the funding of the business. The interest increase year on year is split half and half between the increased debt associated with the acquisition and the increase in interest rates. The closing debt of 21 million is higher than we'd like, and definitely a focus of management to control and reduce, hence our cessation of the refurb programme in January. However, I wanted to bring to your attention what happens to this business when we deliver a stronger year with growing revenues. And we can use FY22, the middle column on this slide, as a small case study. So you can see in that middle column, we started FY22 with 3.6 million of net debt, and then delivered a stronger EBITDA performance, which together with working capital benefits, delivered deleveraging of nearly £8 million to the 4.1 million of net cash. That deleveraging of £8 million was having spent 7 million on CapEx, which just goes to show how when this business has a strong year, when the guest is coming out to play, it's highly cash generative. On that, we are being cautious with our look-forward assumptions after FY24, but for every £1 million extra sales, we would expect to deliver at least 50% of that, if not more, into incremental EBITDA to invest either into the estate, expansion, or deleveraging, which is pretty exciting either way. In the meantime, we are pleased to retain the strong support of the NatWest, our bankers, who've waived all profitability-related covenants associated with the facility, leaving only a minimum liquidity covenant, which matches the cash flows associated with management's downside forecasts. We thought it important to show the headroom trajectory since the start of the year. So over on the left-hand side, you can see, as I mentioned on the earlier slide, we're starting the year in a net cash position. So that's the dashed line that you can see, starting above at 4.1 million. And then we use our facilities to buy Peach to diversify the group, and then taking action after the impact of the cost of living, train strikes, etc., to hold our debt levels other than normal working capitals pretty much since then. Up until pausing our refurb and rollout programme, we've completed 24 bar refurbishments, and these largely, with a handful of outliers, deliver payback within 2 years, with refurbished bars significantly outperforming those not recently refurbished. So it was with regret that we had to pause the refurbishment programme until trading recovers. We've budgeted £5 million of CapEx for FY24, with no material refurbishments planned, though some profit protection sparkles included, but can reduce this if necessary to remain within the newly agreed facilities. So in summary, look, we did what we said we were going to do in some of the most turbulent trading the UK has seen in years outside of the pandemic. We delivered the IAS 17 EBITDA as guided in January, and also delivered net debt in line with market expectations. While the acquisition of Peach Pub did move us back into debt, it has delivered on the stated aim of diversifying the business in a year where Christmas was again heavily impacted, this time by train strikes. While trading remains very tough, we have a supportive bank and fewer covenants than we had this time last year, and Christmas is looking really good. Year-to-date like-for-likes are -5.5% versus last year, with this having improved to -3.5% in the 3 weeks prior to reporting, as students return and corporates come back after the Christmas break. We do expect IAS 17 EBITDA to be in line with market expectations this year for FY24. However, this assumption is on the basis of a Christmas uninterrupted by train strikes and nothing else horrible happening. While our forecasts beyond the current financial years remain cautious, we look forward to returning to cash generation and deleveraging swiftly when the consumer environment returns to something more normal. And on that note, I'll hand you back to Rob to talk through the business in a little bit more detail.
Thanks, Dan. So looking at the group from a strategic point of view, as I say, the big part we were trying to do last year was diversify the group to help strengthen it for the future and look for other growth opportunities. That led us to the acquisition of Peach, which, as Dan's taken you through some of the numbers, we see as a very successful acquisition, and again provides us with a significant opportunity for growth in the future. Dacuba, as I said earlier, is outperforming the market and has got real positive momentum behind that brand. Again, I'll come on to talk about some of the detail in that, but we focused heavily on this brand about 12 months ago to make sure the proposition was right, and we are now seeing the rewards of that effort from the team in the Dacuba, from the Dacuba guys. So we'll come on to that. Revolution is the most challenged part of our group currently. However, it is benefiting. We put a value food promotion into the business at the start of the summer. That was for initially a short period, but we've decided to extend that through until the Christmas period because we are seeing such good uptick on consumption of that. So we have shifted the dial about just over 35% on number of meals sold in that part of the business. So just sort of speaking again to the guests love the product, they just can't afford to access it right now. So providing that better value is a strategic focus for us over the next 12 to 18 months, where we see that consumer group remaining relatively constrained. But with a strong student return, we are starting to see some green shoots in that brand. Again, being a big focus for us currently. New concept developments, again, Founders & Co. We see this as a real engine for growth in the future. When we have the capital to do so, we would look to expand this across the country. The number one site, the original site, is doing very, very well, and we look forward to being able to grow that in the future. And then management's focuses right now clearly is about driving footfall. A big part of that is we have implemented a new CRM marketing system. We've got 3.6 million contactable guests through that system, and we are now having weekly and monthly campaigns rolling through that CRM marketing system. And we are seeing good direct and indirect spend coming from that new initiative. Pre-book revenue is clearly a big focus for us, and certainly the guests in a post-COVID era, pre-booking your night out has become more of a trend. We had a sales team in place to generate pre-booked income before the pandemic, and they have continued to deliver excellent results since then in a market that is favouring, as I say, pre-booking. And I'll take you on to some of the highlights on an individual brand basis. And then I alluded to that cost efficiency piece where we have clearly been interrogating all costs with a big focus on labour being such a big part of our cost base, and seeing good returns from implementing an upgraded labour management system, which is very much focused on productivity, and that's delivered good savings for us this year. What we are also doing, and we've spoken about, is some estate rationalisation. So we closed 2 bars, Clapham and Putney, during the trading period, and then since the end of the trading period, we have closed another bar, which is Revolution Dacuba in Bristol. All 3 bars were loss making, and we had an opportunity to either come out with a premium payment from another operator, or indeed had the option to hand back the lease to the landlord. And we chose to exercise that option. So before the pandemic, we were continually sort of reviewing the bottom end of the estate, and that absolutely remains the focus going forward. So just looking then in more depth at each of the brands. So Peach Pubs, trading really well. Look, we didn't have the summer that we have had in the last couple of years. So, when the sun comes out, peach sales go up. And as we know from previous, the bar sales drop. The bars tend to be landlocked. We do have a few rooftop gardens and one thing another, but invariably the long hot summers of the last couple of years have dented sales. We've then bought 21 beautiful gastropubs with gardens and had quite a wet July and August. That said, because sales have continued to be strong, we didn't just see what could have been an absolutely spectacular performance during July and August, which was clearly impacted a bit by the weather. But either side of that has performed very, very well. Integration is on track. So we highlighted it at the point of purchase that there was about 1.5 million of synergies to be had. I'm pleased to say that we're on track to deliver those, and we'll have tipped over by the time Christmas comes. We'll have realised on a run rate basis a million of that 1.5. The last 500,000 is the sort of longer term contracts, IT, etc., which will take slightly longer to unwind. We said that they would be fully realised by FY25, and we still are on track to deliver that. As I alluded to earlier, we're delighted to add one to the stable of Peach. So we've opened the Three Horseshoes in Letchmore Heath. So for anyone who lives in the sort of North London / Watford area, the Three Horseshoes at Letchmore Heath will launch as a Peach Pub on the 8th of November, so next week. And that is our, as I say, the first addition to what we hope is the first of many, because we do see huge potential for growth in Peach right across the country, but sort of moving out from their heartland. And I know Dan says that there should be one up in Cheshire way, certainly up around Manchester. We've really focused on premium. So when we took over Peach, there was 3 categories of pub. There was casual, there was classic and premium. There was two casuals and 1 premium. We've actually turned the 2 casuals into classics. So there's this sort of core, brilliant gastro pub offering. And then we had 1 pub that was slightly more premium. And again, we've just gone round the proposition on that, really sharpening it all up. And that's driving us, you can see a picture of it there on the right-hand side. The Thatcher Tame, driving an increased spend per head, but also number of meals sold in a week. And I'm pleased to say that the Three Horseshoes will become our 2nd premium pub, because again, we see the increased premiumisation trend continuing. So yeah, really good news on Peach, performing well. Across to the Cuba. Again, in a market that's been reported from January this year up until last month to be running anywhere between -7 and -10. That is the whole of the bars market in the UK. We are pleased to say that Revolution de Cuba has consistently been ahead of this every month, and has now trended through and come up into actual growth versus the prior year. So, a lot of work from this team on a brand proposition refresh, sort of this time last year, looking at our happy hour promotions, how we welcome guests, what the entrance to the bars looks like. Also getting back to our roots on food and that real authenticity from restaurant owners that we know in Cuba, and taking their recipes and understanding what the products they're using, and then replicating that for the British market. And then also a big focus on our entertainment offering, which is resonating well with the guests. The other part of to Cuba is it's got slightly more corporate guests than Revolution. And what we are seeing is that the corporates, with a work from home culture, certainly on a Friday, they seem to be getting the teams together and trying to do more team building because of teams are working remotely. Revolution de Cuba is a net beneficiary of this, with lots of pre-booked events, especially our cocktail masterclasses, which are about team, who can be the best in the team at making cocktails. You can see at the bottom there, 57% growth year on year for that. Brunch is also a big driver post-COVID, 58% up versus last year. And then Christmas bookings for this brand are actually up 26% year on year. So again, corporates really dialing into needing to treat their teams and make sure that they are feeling good. So Cuba doing pretty well indeed, and getting stronger all the time. And then looking at Revolution, as I discussed at the top of the presentation, it is a demographic that's been hardest hit by the cost of living crisis. If you look over on the right-hand side of this graph, this chart, the Russell Group universities did a survey from their students, and the average student is left with only £50 a month for discretionary spend at the end of each month. So it sort of goes to show, we are fighting for our share of that £50, but it is a difficult guest base. You tied that with, young professionals is also a big makeup of our guest base, and as a proportion of their income, rent, phone bills, utilities is clearly a bigger impact than someone later who's in the later stages of their career. So if we look at the strategic initiatives there, we are currently doing the brand proposition work that we did into Cuba last year. We are in the middle of doing that for Revolution and look forward to rolling that out in the new calendar year. That is work that is well underway, but we'll be ready to roll out in the new financial year. And we expect to build on those green shoots that I talked about as those brand proposition changes roll out. We've actually also just put in dedicated resource to look at our entertainment and atmosphere creation. We know that when people can afford to go out, they want good entertainment, they want experiences. So we've put dedicated resource in to make sure that our music and entertainment offering is absolutely the very best on the high street. And then as I've already talked to, we are managing the bottom end of the estate with Clapham and Putney having exited the brand. And then the footfall driving initiatives in the middle of this slide, the £2.99 meal offering that we put in, I've already talked about, 35% increase in the number of meals sold, and that's coming through at a 5% increase in revenue. So a big uptick in number of people through the door, and that's come through into a revenue driving as well. So profitable for us and doing well, so more of that. What we've also seen is this need to be entertained. So we've put in Bangers Bingo into half the estate on a Friday. That's a once a month, and those bars are doing 18% better on those Fridays than bars that are not doing it. So again, the need for entertaining this young guest base is there to see. Very successful student return with Halls of Revidence as the campaign. And again, to the CRM platform, we've signed up over 200% more students this year than we did last year. So absolutely fantastic. And again, we've just put in there about Christmas bookings in Revs, also up 13% versus what was a record Christmas for pre-book revenue last year. So some things to be cheery about in a brand that's in a difficult market. New concept wise, Founders & Co. goes from strength to strength. Absolutely delighted with the performance of this brand. And as soon as we are able to, we will look to expand this with a second site, which we've got our eyes on. But equally, our first aim is to pay the debt down before we start opening new bars. So that is on hold currently, but we are very excited about the future of Founders & Co. Playhouse, 2 of these sites. This was designed to take underperforming legacy Rev sites where we might have had the bar for 18, 19, 20 years, but we've got a lease for 25. And the circuit had somewhat moved. So this was creating a high profit model. So we've put in lots of machines, and I'm pleased to say that almost 35% of our income now is coming through gaming machines, which is clearly highly profitable. That said, they are in 2 very, very challenged towns. So for now, we won't be doing any more of those. We will just sit with the 2 of those currently as they are. So that's new concepts. So in summary, we are doing lots to drive sales and really help drive that turnaround, especially in that Revolution brand, whereas we've seen the turnaround sort of start to build momentum in Cuba, and Peach continues to perform pretty strongly. And then that active cost management, as you would expect us to be doing. Utilities have come down from their peak. We are mitigating lots of cost increases by having the greater buying power of peach in the group now, and we are negotiating with our suppliers in order to mitigate those cost headwinds that have been so widely reported in the media for the last 18 months. So take a very proactive approach on cost management. I've talked you through the closures in the estate, and again, we will continue to work on a handful or so of the bottom end of the estate where, if it makes sense to come out of them, then we will. But also exploiting all the opportunities available to us, especially with the CRM platform, it is a big one there for us. And then maximising, as Dan's alluded to, the all-important Christmas trading period for us, and to have bookings so far up on what was a record pre-booked Christmas last year is testament to the fact that corporates are looking to come out and spend with us, and make sure their teams have a brilliant time over Christmas. So with that, just looking at the outlook for the future, look, there's no getting away from we are in a difficult consumer environment, but with utilities pricing having peaked, and certainly we buy in the market, and we've forward bought most of our energy consumption for the next 12 months and a considerable amount for the next 18 months. And we buy that on a dynamic basis at the best prices we possibly can. But it certainly has been trending in the right direction. What happens with the Middle East conflict remains to be seen. Interest rates do appear, I don't want to jinx this, but appear to have peaked. And I think they've held them again today, by the sounds of it. So, and consumer confidence at the time of writing was rising. It's certainly come off the floor, so to speak, but it does still remain tricky, especially for those younger guests. But the initiatives are starting to deliver, so we feel quite buoyant that we've delivered a 6.6 million EBITDA number in what was a very, very difficult consumer environment. And we see from where we're sitting is that the environment, whilst remaining difficult, is starting to show sort of glimmers of being better, certainly for our guest base anyway, with students having returned this year slightly better than they did last year. And then look, recent like-for-likes for the first 15 weeks of the current financial year at -5.5 is better than where they were for the full year last year. And then in the more recent weeks leading up to reporting at -3.5 just shows an improving trend on that number, which is great to see and testament to the hard work of the team. Peach is doing brilliantly. DeCube is ahead of the market. Revs is showing some green shoots of recovery, but that brand has still got a tough sort of 6 to 12 months ahead of it. Founders & Co is a fantastic, if you're ever in Swansea in South Wales, I highly recommend you visit. It is a wonderful place to spend time in, and I would encourage you to do so. Christmas is on track to beat a record pre-booked year last year. So look, we think we've got a well-invested estate. We've got a supportive bank. We are managing the costs effectively, and we are sat here in a position where as soon as the consumer does turn, especially in that younger guest base, we are highly, highly cash generative. We paid the debt down very, very quickly in FY22. We can do the same again. Primary focus for management is to get that debt level down before we then start growing the estate in real terms for the future. So look, there concludes the presentation. And I think we're just going to switch over to questions now.
Rob, Danielle, absolutely. And thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Danielle, Rob, we did receive a number of pre-submitted questions ahead of today's event. And as you can see there in the Q&A tab, we've also received a number of questions throughout your presentation this afternoon as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Rob, Danielle, if I may just hand back to you just to read out and address those questions where it's appropriate, and then I'll pick up from you at the end. Thank you.
Brilliant. Thank you, Jake. And just to reiterate that, thank you very much to everybody for attending and for submitting the questions both in advance and during the call. First question that came in was, what is the company's plan to reduce the debt, and is this a priority for the business? And as both Rob and I have chatted through during the call, yes, this is absolutely a priority for the business. In terms of the plan to reduce debt, that will be slow and steady this year. We're taking a very cautious view on the outlook. And slide 7, which is the liquidity slide, shows that during this kind of softer trading period, we are holding the debt levels other than normal working capital cycles. And I'd expect that to be more or less what carries on during FY24, a small debt reduction, but nothing dramatic until we start to see the guest return. But it's absolutely a priority for the business, as you've heard from both of us. Then asked a separate question, noting that at the takeover, it was reported that an anticipated EBITDA for Peach was £5 million. Was this achieved? If so, what's the operating losses of the remaining part of the business? And can you talk in more detail about how the different brands are trading? So the anticipated EBITDA for Peach of 5 million is under IFRS 16, so that's before rental charges. We said that the IAS 17 mature EBITDA was expected to be £3 million, which included the delivery of some significant synergies, which we are well on with delivering. We've delivered some people savings in terms of the initial owners of the business who've left. We've delivered some supplier synergies, and they will mature during this year with an expectation that we hit that 3 million EBITDA during FY25. But the 5 million was pre-rent and the £3 million is post-rent. In terms of, can you talk about more detail about the different brands that are trading? I think we've covered that off with Revolution Tequila, Founders and Peach trading well, and Playhouse and Revs just being challenged with the guest space at the moment in the cost of living crisis, but the detail was in the presentation. Question number 3 was, I note you have exchanged contracts on another pub. That's the Three Horseshoes that we've referenced. From a capital management point of view, is this a cheaper acquisition, admittedly might not be available in the future, than merely buying the same value worth of shares and owning a higher amount of the existing pub estate? Given depressed share price, any thoughts re buybacks as opposed to expanding the estate, recommencing the refurbishment programme? So taking the first part of that programme, yes, it absolutely was a bargain of a pub, a peach of a pub, in fact. So it was relatively low in terms of the capital investment required at sub 100, around about £75,000 worth of capital required for that. We own the full trading estate. We lease them all, but we own the full peach company and the entire estate attached to that through a lease process. And then given the depressed share price, any thoughts re buybacks? No, not at the moment. At the moment, the focus has got to be on reducing the debts, as you've heard. So that has to be the first refocus. Although recommencing the refurbishment programme, there is a long list for us to look at as soon as we've started to see that cash starting to flow through. And back to that FY22 case study, when we see the guests come back, the deleveraging happens very, very quickly. And it's very exciting to see. This question was for Rob. Given it's been a year now, please talk us through the merger. What went well? What didn't? Anything you do differently? Given the distressed state of the markets, are there any other opportunities on the radar? Do you think RBG is now set up to acquire and then plug and play any other opportunities and flex the existing back office capability?
Okay, certainly taking the first part of that. So from an integration point of view, look, it's gone very, very well. As you've heard, sales have continued to be very strong. I think we reported 14-point-something% up on the pre-COVID levels. So trading has remained very strong, which is always a first risk you worry about with integration. Does the momentum in the business slow? Well, it hasn't. It's just continued to do very, very well. And then from a people point, which is so important to Peach, that sort of culture and what they've created there, I'm pleased to say that we haven't lost anyone from a senior management team point of view. So in the pubs, managers, head chefs, and then in the support centre as well, the team is largely still in place. And I guess that is testament to how that integration has gone. We're a year in now, and as I say, the core team is still there. There's been some churn at pub level, but that's just in the natural course of business. But actually, we haven't lost anyone that the group wouldn't have wanted to be losing pre our ownership. So culturally, it's gone very well. People, it's gone very well, and performance, it's gone very well. So nothing we would particularly change at this stage. With the market how it is, are there going to be other opportunities out there? look, the pub market has stayed quite buoyant, and certainly in that premium pub space that Peach plays in, there are a number of active purchases of certainly the freehold assets in this marketplace. We would be looking at leasehold, which gives us a slight advantage. So look, there'll be opportunities out there, but as Dan's alluded to, our number one focus right now is paying down the debt that was used to buy Peach in the first place. And once we've done that, then we would, we will look at growing that Peach estate rapidly at that point. So I think that answers that one.
Thank you. Next one was noting that a response to the cost of doing business pressures was to have some venues close on Mondays in the slow months, January. Was this a successful programme? And the rest of the question goes on to ask, is this something you would have to do more of in the future? And I think in terms of in January, was it a successful programme? Look, January is always incredibly quiet, and therefore closing some sites when there's very few guests to come in gives our management teams a bit of a break, and certainly reduces the losses that you would expect to see in those sites in the early parts of the week. So in terms of that part of that question.
Yeah. Yeah, and look, will we do it in the future? Yes. The answer is, having done it last year, it was profitable to do so, and I think you do see more and more of it in the marketplace. Lots of independents now not trading Mondays, Tuesdays, because they've worked out that the guest base just isn't around. And look, with working from home on a Monday, there are certainly in the quieter months, the Januaries and Februaries of this world, we would look to do take a similar approach that we did last year. So it's not brand wide, but in the location, if there just isn't a footfall on a Monday and Tuesday, as Dan said you may as well give the management team or the A team, if you like, a rest on a Monday, Tuesday, so everyone comes back fresh for the days where the trading is there, and it helps profitability, but it also helps with guest experience and a number of other metrics.
Cool. Noting in the last presentation by your competitor, Nightcap, they mentioned that Fridays are well down, however, Saturdays have exploded in popularity since COVID and work from home. Has this been your experience? Is there a pricing response available? And any thoughts around trying to monetize the increased Saturday demand via higher prices?
Yeah, look, I think Saturday's exploding in a marketplace that, as I said, the industry tracker says that it's been down between -7 and -10 for the last 12 months. Exploding might be overstating somewhat, but that's their view of it. Saturdays are still the busiest day of the week. They are still trading very well. Like I say, I probably wouldn't use exploded, but they are buoyant. Fridays is a problem with people working from home. The Revolution brand, again, particularly, was a fantastic place to go for a post-work office party on a Friday afternoon that then led people staying out way beyond what they were anticipating being and waking up with a sore head on a Saturday morning. Now, if they are not in the city centre, that is not a market that is available to us. So part of that brand's diversification is now working with retailers and hoteliers and saying, well, look, if there isn't a workforce guest in the city on the Friday afternoon, who are using the cities? And we are pivoting that brand to look at tourists, shoppers, etc., and therefore working with retailers doing pop-up bars in the clothing retailers that play to this market, but also getting into the hotels that are being used for leisure stays on a Friday and getting sort of flyers put on pillows and things to drive footfall in from those hotels. So, we are definitely having to pivot. Pricing wise, we've always had a price for the weekend, price for the times where you've got the footfall, and discount back early week. And that's still what we do. It's cheaper to come and visit us during the week because there'll be more promotions running. Happy hour will be on for longer. There's less happy hour available on a Saturday for the reasons of higher footfall.
Good. Noting the success of the refurbishments when happening, do you think this is reflective of theme fatigue? And do you see the core Revolution brand having continued upside? As part of this, the two new Revolution bars, Exeter and Preston, how are they tracking? What was the original ROIC and what is the expected ROIC? So do you want to take the theme fatigue and I'll do the rest?
Yeah, look, I think what we see is when the guest is coming out, so, they're clearly constrained by cash currently, but pay weekends are still a good barometer. And then things like Halloween, a couple of days ago, the brand is still doing fantastic trade with full venues up and down the country, queues waiting to get in. So the brand, as I alluded to in the presentation, the propensity to recommend post a visit to Revolution has never been higher. So the brand equity is still very much there. They love the product. They just can't afford to access it as often as they would like right now. And that's where, we are somewhat reliant on that guest feeling like they are better off as inflation falls, etc. But they certainly bore the brunt of increased rents. Landlords didn't wait for their mortgage to go up to put the rent up. So these guys got hit with rent increases very early on in the cost of living crisis and have been suffering with it for longest. So look, we know that the relevance of the brand is there. Yes, we're going to do a brand proposition refresh just to make sure that we are absolutely best in market. But when the guests can afford to come out, we are seeing queues waiting to get into the venues and full venues. So hopefully that answers that bit.
Yep. And in terms of the ROIC, we normally sign off a new site with an expectation of about a 4-year payback. Given the energy costs spiked and the current trading, it's likely that extra impression will be a little bit longer than that. But then as the guest comes back, then they'll come back towards that 4 years-ish. And we would certainly, when we were signing off any further new bars ever, then we would still hold that around that 4 years. But interestingly, given the low capital investment in the 3 horseshoes, that will pay back much, much quicker, probably within about 12 months.
Yeah.
Given the scale benefit of the acquisition of Peach, how are negotiations with suppliers progressing? Have we hit a scale whereby significant savings can be made? And then noting the distributors seem to have a snafu. I don't know what a snafu is, but seem to have a snafu with a new system. Have we managed to recoup the costs incurred? So 2 completely different questions there. One on the acquisition of Peach and one on the distribution.
Mm-hmm. So distribution-wise, yes, our main wholesaler did have technical problems. It had a material impact on product availability and also tying up management time, where instead of running bars, our guys and girls at site had to be hiring vans and getting down to the local wholesaler and purchasing product. What has been made good is the differential in the cost price. So what we were having to buy stock at locally versus what we would have got it through our supply chain has been made good. So that bit is taken care of. What is harder to quantify is the management time that was taken, but also when you're off buying beer, you're not focused on the team or the guest, and that's what we'd want. So we are pleased to say that is now behind us. Like I say, product costing was matched, so that's absolutely fine. And then the first part of that question was
negotiation with suppliers for Peach.
Yeah, so we have done most of the food. We are just on with the drink. And most of that will be implemented before the Christmas trading period. Some of it will just flow over into January. And at that point, we'll have been on a run rate basis. We'll have delivered circa 1 million of the 1.5 million, which I alluded to in the presentation.
Yeah. So given the surrendered leases and closed bars, if economic times recover, can these sites or locations be brought back up relatively quickly? No, these have been released to somebody else. Somebody else has taken over those sites, so we wouldn't be reopening them as any of our brands in terms of those surrendered leases. And we don't have any bars that are just doors closed. So that was a relatively quick one.
Yeah.
There was a question about an Australian retailer. This is probably only a question which Rob will get, but Dusk recently, an Australian retailer, launched a collaboration with Streets for a paddle pop range, surprisingly a massive hit. Wondering about things like a Barbie range of drinks, probably more on the branded brunches, I would have thought.
Yes, I'm aware of them, and we've tried to do a few brand collaborations recently. I won't mention the brands because I don't think we've spoken about them publicly, but we have looked to do a very similar thing. Unfortunately, what you do need to get round in the UK is making sure that you are not appealing to children with alcohol-related products, which is completely understandable. So therefore, things like teaming up with Barbie or a sweet manufacturer, or as we talked about there, like an ice pop, ice lolly sort of manufacturer, becomes very difficult. The Portman Group in the UK, quite rightly, have got a loud voice on this, and the potential blurred lines of the children's appeal of an ice lolly versus alcohol consumption. You can see where that gets all a bit messy, and that's why the Portman Group exists, to make sure that line doesn't get blurred. So we have done and we are exploring opportunities for brand collaborations in this space. So yes is the answer, but it is not straightforward based on the fact that some of the things you'd think would make complete sense is actually more difficult than you might imagine. What I would say we do in bar is when the things like the Barbie movie launches or things like that, then we do themed nights and themed events in the bars to appeal to our guest base. So it can't, if it appears on a shelf in a retailer, we've got very little ability to make sure that it's not appealing to children, whereas actually in our bar, which is aimed at 18s and above, we obviously can. So we absolutely do theme nights around big movie launches or big touring international artists that are coming to the UK. We do all of that sort of thing on a rolling basis, as you would imagine. So that's how we capitalize on that. But yes, we do look for brand collaborations where possible as well. And that is an avenue for the future as well.
Cool. Any opportunities in other markets like Ireland? I think there's a lot of opportunities in Great Britain and Northern Ireland at the moment, rather than potentially stretching further out. There's definitely an opportunity for Peach to come up north. There's a number of cities where we either don't have a Revs or don't have a Decuba. So I think the opportunities are more local than going internationally at the moment.
Yep.
Cool. Noting increased reliance on pre-booked revenue, how advanced are discussions with groups to drive visitation, e.g. tour companies? Has RBG considered getting into the organised pub crawl market, e.g. urban wine walk, Uber experiences, etc.?
Yeah, so we do quite a lot of this. So locally in certain cities, and certainly Edinburgh is one that gets lots of tourists, we are on the circuit for pub tours, if you like, around various cities. So yes, we do that. And then as far as experience goes, we are listed on, and you're all welcome to buy your Christmas presents via here. But Virgin Experience Days carry a number of our afternoon tea products, our masterclass, our cocktail making products, etc. So we do quite a lot in that space, yes.
What is the runway for RCF reduction over the next 6, 12, 24 months? As I said, gradual until we start to see the guest recovering, and then it'll be relatively quick because we'll see that sort of build through revenue. As I said, for every incremental £1 million worth of revenue, then you would see more than half of that drop through and be available either for deleveraging or for investment. Noting the premiumisation drive happening in the pubs, has this been successful? At acquisition, they spoke of a variety of types of pubs, one premium, a few standard, etc. How have the different types fared? What plans, if any, to focus on premiumisation across all of the brands?
Yeah, look, I think I addressed the Peach point as part of the presentation. So we are definitely growing the premium end of that estate. I mean, I caveat that with they're all quite premium pubs, but this was a next level up piece. And then, yes, in the bars, again, we see a continued push towards, again, when I'm going out, I'm going to splurge and almost forget my daily worries. And therefore, we already stock a pretty premium range of drinks across the bar. So, yes, that will continue.
Great. Given the increased focus in digital, including now having Maria for a year or so in this space, what response are you seeing from investment? Have social media become more important as a source of driving pre-booked revenue? How would you assess the capability to quickly deploy digital strategies to change visits, drive up use, e.g. in response to a train strike?
Yeah, so again, the CRM platform is now fully up and working, and that has now given us the capability to respond to things like train strikes, so we can push out an email to those 3.6 million people when we know that we've got potentially a stormy weekend, or we've got a weekend disrupted by trains, etc. We've now got that capability. This time last year we didn't. It's been implemented since the start of this calendar year and is now up and running, and we are running sort of campaigns to sort of understand best response. So what does our guests respond best to? Is it a percentage off? Is it a 2 meals or drinks for a certain price? So what is the best offering? So we're still in a slightly test and learn phase on that, but yes, we now have got the capabilities to react to those events around us. Was there another part to that?
No, I think you covered it.
Okay,
yeah.
Great.
And then this is the final pre-submitted question. With Mark, Alex and Chris each having ownership of the 3 core brands, how are you fostering collaboration between the key groups? Are they run as separate business lines? Noting the change because of the merger with Peach, but do you think this structure is working? Is this an effective way of structuring the group for potential future acquisitions?
Yeah, look, I think we run it as a group structure. So the support centre covers all of the brands. So the operational teams are aligned, and that's important, especially from a Revolution and Revolution to Cuba point of view, to keep the operators slightly separate. Otherwise, they end up morphing into one offer. So they are led individually from an operational point of view. But from a support centre, they've got the group covering them. So the same people policies run through, et cetera, et cetera. So we see that as the best mix to keep the brands differentiated and that real ownership at a brand point of view for what is the unique selling points of each of those brands, but having the support centre at a group level covering all of the brands. So as everyone gets consistent support. So hopefully that answers that.
Yeah, so they're all the pre-submitted questions, and then there's been a couple to come in live. Can you please talk to the run-up of Christmas marketing spend, consumer demand returning? Do you envisage this period to be particularly fruitful for the business?
Yeah, look, hopefully you've got a sense through the presentation that we are very pleased that pre-booked is up at that 17.7% up versus, as I say, what was a record pre-booked last year. So we are definitely seeing a trend towards corporates wanting to reward their team with a bigger and better Christmas party. And let's face it, teams are not getting together as often as they were in the offices. And so therefore, it looks like corporate employers are deciding to have a bigger and better Christmas bash each year. So it was, as I say, a record year last year. We are well up on that record year thus far this year. So that appears to be an increasing trend, and it is our most profitable period of the year. So all the indications are that it's very strong. Train strikes impacted the walk-in business last year. They didn't necessarily impact too much on the pre-booked revenue. And look, we don't know whether there's going to be train strikes this year or not. They may well line up with last year's train strikes if there are train strikes, but that is somewhat out of our hands. We do lobby government and the unions hard to make sure they realise the impact on our teams and indeed the great British public not having had a fully open Christmas either through COVID or train strikes for 4 years now. And we think they deserve it.
They're struggling to get on and see the others.
There's one here about train strikes. You mentioned,
You mentioned train strikes. Sorry, struggling slightly. You mentioned train strikes as being a mitigating factor a number of times. Are you able to give any comparable stripping out the effect of these strikes? We've not given a comparable. What we have said, it was worth a couple of percent miss on the like-likes, a couple of £1 million over the course of the year on the days and the shoulder days next to a train strike. What is harder then to understand is the lack of confidence, particularly over that Christmas period, of what happened in between train strikes and were we confident that the trains were running and were they going to run on time and was I going to be able to get home if I left the bar after 11 o'clock, say. So that's the harder bit, but the pure train strikes impact was a couple of percent on the like-for-likes and a couple of £1 million missed over the course of the year. But that confidence bit is harder to unpick.
Yeah, and look, we are at the mercy of trains. Lots of our weekend guest base are getting together, pre-booked groups coming from north and south, meeting up in it could be Birmingham, could be Manchester, could be Leeds, wherever. And if the trains aren't running, that group aren't travelling from wherever they're coming from. So it does have a material impact, and they have, unfortunately, it's now been going on 16 months. They have targeted pay weekends. For most of their strike weekends have been targeted pay weekends, which is a weekend that is disproportionately large for us as our guest base get cash into their pocket and come out and have a blowout on that pay weekend. There's one there about clarification of expectations for FY24. Right down the bottom.
Yeah, could you clarify what the market expectations are for FY24? Yeah, from an IAS 17 EBITDA, so that's having paid our rent, market expectations are 7.5 million versus the 6.6 million that we achieved in FY23. The main difference being the annualisation and delivery of synergies for Peach. So that's the step up between the 6.6 and the 7.5.
Okay, I think that concludes the questions that we've got. So I think I'll hand back over to Jake.
Perfect. Rob, Danielle, thank you very much indeed for being so generous with your time then, addressing all of those questions that came in from investors. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Rob, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Yeah, thanks. Look, hopefully you've got a sense through the presentation of the three core brands. One doing particularly well in Peach, another brand outperforming its marketplace into Cuba and now up into growth is looking really good. Revs, as we know, is where the focus is currently. That younger guest base is under pressure, but we are focused on the costs. We are driving lots of footfall driving initiatives and a brand proposition refresh coming up for that brand as well. So we feel like with the guest metrics and propensity to recommend never being higher across those three brands, it is an affordability piece for that younger guest. And as soon as that recovers, as Dan's alluded to, we generate lots of cash. Management's number one priority is to pay that debt down with that, get that back to somewhere nearer the sort of 1 times that we've referred to in the past. And then we've got 3 brilliant avenues for growth going forward, 3/4 with Founders & Co being a real, we need to do a second site and understand does that go as well as the first? But if it does, then we feel like we must be onto something, and it's something that could reach scale as well. So, positioned for growth, managing it prudently for the next sort of 6-12 months while the consumer is still fairly well constrained. But then with good avenues for growth for the medium to longer term.
That's great. Rob, Danielle, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Revolution Bars Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.